I'm Matt Bishar with REIT.com. Joining me for this episode of Fundamentally Speaking is Calvin Schnure, NAREIT's Vice President of Research and Industry Information. Calvin, thanks so much for joining us.
Thanks for having me, Matt.
I'd like to start by talking about the economy. The stock market underwent a roller coaster in October due to some ongoing fears about the recovery in the economy. What's your take on those concerns and what's your outlook moving forward?
We did see a lot of volatility in the month because mostly concerns about global growth. We had a lot of weak news out of Europe. There were concerns about the impact of the global economy on the U.S. People were also worried the strong dollar might be hurting the U.S. economy, might be hurting the U.S. earnings, U.S. firms that are earning abroad. But what we've seen is the U.S. economy still is fairly resilient through all of this. The economic data flow, yeah, you have some strong numbers, some weak numbers. We shouldn't focus too much on any monthly number because overall we've seen continued steady improvement in the U.S. economy. We're seeing the job market holding in very well. The job market is a good indicator that the U.S. economy is gaining strength and gaining momentum. We're just coming through third quarter earnings, and so far corporate profits are exceeding expectations. That's an indication that business fundamentals are fairly sound. This is all saying that the market fears that the U.S. economy could stumble were really overblown.
One of the other developments in the financial markets was that interest rates fell again. What's your take and outlook there?
We did see a lot of action on the interest rate front this month. The important takeaway is that last year's fears that the Treasury yields were going to take off from 3% and go higher, well, that never materialized. We are not facing a sharp up ramp in interest rates. We are seeing interest rates that are still at very low historical levels, and even if there is some continued ramp up from this over the next couple of years, it's not going to be nearly as important as the fact that occupancy rates are increasing in the real estate sector, that rent growth is increasing in the real estate sector. So what we're seeing is a very benign interest rate environment, moderate growth, no inflation risks. The Fed is reasonably patient with how the economy is going, and the rising occupancy and rent growth in the commercial real estate sector is really going to be the driver going forward.
And now picking up on that, last thing I want to talk about is the commercial real estate sector. And with everything that you're seeing, what's your take on that heading into the new year?
You know, we're seeing a moderate improvement in commercial real estate. This is not a gangbusters market by any sense, but we are seeing that even as there's new supply, the demand is there. People have raised some eyebrows about the new supply. It's up quite a bit over 2 or 3 years ago, but that's only because 2 or 3 years ago was very low. There was very little new construction in the aftermath of the Great Recession. That's normal. So it's also normal to see more supply coming along. But the important thing is the demand is coming along as well. So you look at the multifamily sector, we're seeing very good demand there. There's a lot of pent-up demand. After the housing crisis, the apartment sector is doing quite well, even with the new supply coming along. Similar thing in office. We're seeing a lot of job growth. That's helping translate into demand for office space. You know, you can look at the other property sectors, but overall, as the economy continues to gain momentum with a moderate increase in supply, we're seeing very good fundamentals for the real estate sector going forward.
Calvin, thank you so much for joining us.
Thank you, Matt.
For more on this and other REIT news and analysis, be sure to visit REIT.com.